I've managed to get hold of Tony Cousins, pulled him down from the UK and all the shenanigans that are going on in the politics and the financial world there. Thanks for joining us in Cape Town, Tony.
Great to be here, Rob.
Tony Cousins is the CIO and CEO of Pyrford International, portfolio managers of the Ned Group Investments Global Cautious Fund. I'm going to leave him to run through a few slides for us, introducing what's been going on in terms of the performance of the fund, what's been driving that performance, and potentially how the portfolio is positioned for what's coming into the future. So I'll hand over to you now, Tony, and I'll join you for a few questions in a moment.
Thanks, Rob. We're going to kick off by looking at performance of the Cautious Fund over the last year. Obviously, we're here to talk about the third quarter. Pretty tough quarter, and that was an extension, really, of the last year. So the headline top number, it was a negative return. There's been very few places to hide, but perhaps to dig a little bit further into that. All asset classes were down. Within bonds, we materially outperformed the index returns by having very low duration within the bond portfolio, and I'll come on to talk about that later. But by reducing the risk in that portion of the portfolio, we outperformed the index moves by more than 10 percentage points in both US and non-US dollar bonds. Similarly in equities down sharply over the last year, double-digit declines. We mitigated that again by having a very high-quality defensive portfolio, which enabled us to outperform strongly in those areas. So what didn't work? What didn't work was the currency positioning. We did have some hedges on the Aussie dollar. That added value as the US dollar gained a lot of strength. But in our unhedged positions, those obviously suffered from that strength in the US dollar. So perhaps we should start with that. Let's look at what happened to the US dollar over the last year. This is to almost to the end of September. And you can see against various currencies, the US dollar went up, and obviously much more so against currencies like the yen, the euro, and sterling. Now, sterling's been getting a lot of attention recently due to some of the calamitous policy decisions in the UK, but it wasn't the weakest currency over the last year. That has been the yen, which has fallen to the lowest point it's been since 1990. We have very little exposure to the yen, so that's again a good thing, but we have had exposure to both sterling and the US and euro within this portfolio. So why did we do that? Well, we look at currencies on the basis of what's called purchasing power parity. This is a measure of fair value of currencies for what it's worth. It's driven by relative inflation rates. Now, here we see the red line is the fair value line. The green line is the spot currency. The shading is 25% either side of the red line. So a year ago, the US dollar was already overvalued. But what's happened here is the US dollar has gone to an outrageous level of overvaluation. And as you can see from this chart, which goes back 50 years, it's never been quite in this position before, except in 1985. So we do intend to keep on these unhedged currency positions. We do so within a strict risk parameter of 0 to 45%, and we are up towards the upper end of that, and we intend to persist with this because this is a sort of once in a generation level of overvaluation of the dollar. As it comes back to fair value, then currency gains will be made in those overseas currencies. So what's caused the problems in the last year? I think this is a culmination of many, many years of central banks printing too much money. Here we see central bank balance sheets, and this reflects just how much money they printed. Before 2008, nobody really printed money, maybe Zimbabwe, Argentina, but it really wasn't a legitimate monetary policy tool. The ravages of the financial crisis legitimized this, but with the benefit of hindsight, it was used fairly sparingly by central banks. Between 2008 and 2020, they printed about $9 trillion. However, when COVID arrived, they really went into overdrive and they printed $12 trillion in the space of 2 years. One of the ex-Fed governors, Ben Bernanke, has just won a Nobel Economics Prize for his work on the Great Depression, which showed that if you print enough money, you will cause inflation. And that is exactly what has happened here. We see that inflation has risen very sharply and is now a persistent problem that the central banks have to deal with. They've been asleep at the wheel, partly because whatever they threw at markets and economies over the previous 10 years, inflation just bumbled along at 2%. But with this massive injection of liquidity over the last 2 years, it has now broken out and presented them with a real problem as it approaches double-digit figures in some countries. And the problem is that the inflation, having become entrenched, is very sticky now. It's being driven really by two factors. One is rents, shelter, which is a big weighting within the inflation basket. But the worst type of inflation is wage inflation. And that is what we are now starting to see. Because this has not been a transitory phenomenon, as many central bankers thought it would be, it has become persistent within economies, and workers want to be compensated for it. And we must remember that wages have been suppressed for a very long time. Margins at US corporations have gone up 10 percentage points at the expense of labor over the last 30 years, and they want some of this back. So this is what is happening now, and in order to alleviate this, we are going to have to see the Federal Reserve and other central banks around the world try and crush these demands, and that means, in all likelihood, a recession and the rise in unemployment that is required to suppress these wage demands. What else did this influx of liquidity do? Well, it created an equity bubble. You've maybe heard me talk about this before. I could put any valuation chart up. This here is the favorite valuation chart of Warren Buffett, S&P 500 market cap to GDP, and this got 3 standard deviations above its average. What does that mean in real money? It means variables remain within 3 standard deviations for more than 99% of the time. So this is a very extreme level. It's come down. It came down a bit more in the third quarter, but it's still at a very extended level compared to its long-term average. So there has been quite a severe correction, but it hasn't brought us back to that long-term average. And we've had these bubbles before. The bubble has been in growth stocks, in tech stocks in the US, the so-called FANGs, the Facebooks and Apples and Microsofts and Googles of the world. But as I said, we've seen this before. In the early 70s, there was the Nifty 50 bubble. We remember the dot-com bubble of the late 90s. This one was actually bigger than either of those two. It has been burst, it has come down, but it hasn't again come all the way back down as the previous ones did. So we would suggest that there's more to come in this respect. The other bubble that we've seen is in bond yields. 2 years ago, about $18 trillion worth of government bonds sold at a negative nominal yield. Now that is absurd. History books will write about this, that investors back in 2020 were happy to pay governments to borrow from them. When you put it like that, it really does sound absurd, doesn't it? But that's what they did. And this, with the rise of inflation, these incredibly low nominal yields have driven real yields to in crazy levels here. And bond markets are starting to react to this. We've seen very sharp rises in yields across all the developed market yield curves this year, in some cases more than 300 basis points. And again, we believe there is more of this to come. We have protected this portfolio by having a very short duration. Duration is the measure of sensitivity of a bond price to a change in yield. When yields are going up, bond prices are falling. You want to have very short duration. Conversely, when yields are falling, prices are rising. You want very long duration. And back in 2008, that's what we had. But with yields as low as they've been, we have protected the portfolio with this very low duration. Now, given the rise in bond yields, that is starting to change. We've moved up just 2 weeks ago now from 1.5 years to 3 years. It's not that brave, it's not that aggressive, because we think there is still further to rise at the long end of the yield curve, but we think that will happen, and I think in the future, if that does occur, you should expect us to be increasing duration further within this portfolio. We have also had a very low equity weighting within this portfolio. As you're well aware, equities have fallen sharply, and we have not yet increased this. Because they've fallen sharply, we are much closer to the level at which we will increase the equity weighting in the portfolio. What we do here is we set strict valuation triggers and wait for them to be hit. And when they are hit, we convene a strategy meeting within 24 hours and discuss what we should do. But I will say we have never ignored one of these trigger points being hit. We have always acted to reduce equities if it's a trigger point on the upside, or increase equities if it's a trigger point on the downside. So we're about, call it 10% away from hitting one of those trigger points today. I think as earnings estimates come under pressure, as the tightening on the economy works, we would expect some more weakness in equity markets, and that will be the opportunity to increase exposure to them. So I won't go through this slide in detail. A lot of information on it. What it shows, we are currently have 77% in bonds, 3% in cash, 20% in equities, and the splits between non-US bonds and US bonds. The only other comment I'd probably make is that within equities, we very much favor the Asia ex-Japan region. It's the cheapest region of the world, and within our investable universe, it's the part of the world that has the most promising economic prospects. So these are younger populations that deliver higher productivity, faster growth in output. There is less debt penetration there compared to the rest of the developed world, and we think that those offer much better opportunities than you will find in Europe, which is in a lot of problems, not least because of the reliance on Russian gas, and the US, which is still something of a valuation outlier. So thanks for your time today, and I'll be very happy to answer any questions Rob has.
Thanks very much, Tony. There's a lot of information you've provided us there, so I've got a couple of minutes to ask you some questions. I'll get stuck straight into it. You showed the US dollar valuation being an extremely high point relative to history and across currencies, but what's going to be the turnaround for that? When might we expect that to start to peter out and maybe see some weakness in the US dollar? When and at what level?
Yeah, good point. Well, the level is quite a tough one to gauge, but it's been so strong despite being expensive already because the US Fed, I think, has been particularly aggressive compared to other central banks in its raising of rates. The ECB has talked a lot about it, not done a lot. The Bank of Japan hasn't done anything because it has to keep its yields low in order to purchase JGBs. And the Bank of England basically just moves from one calamitous situation to another, as our politicians really don't do a very good job in the UK. But the Bank of England and ECB will need to act because they have inflationary problems as well. And as they catch up with the Fed, I think that's likely to be a trigger for the US dollar to peak out at this eye-wateringly expensive level.
Early next year?
Yeah, I think so. I think we're getting over this crisis in the UK, but the Bank of England is very straight that they're going to have to raise interest rates and they're going to have to remove money from the economy. The ECB will be doing the same, and this is what the Fed has already done. So those differentials will be narrowing, and I think into the second quarter of next year is when that will be happening.
Okay, thank you. And you said there that the Fed has been the most aggressive in raising rates, and I guess that's another key question is we ploughed through previously touted peaks for what the Fed fund rate might be and therefore 10-year yields. Where do you think that Fed fund rate may peak out and then maybe start to roll over?
Sure. Well, as you say, it's a moving target. If you go back a couple of months, the peak was expected to probably be about 3.25%. It's now looking at 4.75, 4.75. So that's gone up very quickly. I think unless there is a very rapid reaction from the core inflation numbers, that's wages and rents, then that is going to continue, and we could get into the fives. And now that is going to represent a lot of tightening, but it's what they have to do. They have to slow this economy to get on top of inflation, because if they don't, it will just become even more entrenched in the economy.
So if you've got another 2% rise in US bond yields, for example, there's still some pain there to be had in fixed income markets around the world, which is why you're being a bit cautious in terms of extending out your duration.
That's right. I mean, the long end of the yield curve, 30-year bonds have a duration of about sort of 27, 28. That means that if those yields just go up 1 percentage point, you will lose around about 20% of your capital. These are very, very geared instruments. These are the things you want to own when yields start to fall, but I don't think it's quite time yet.
Okay, thank you. And then we just got time for one last question. Let's talk about the equity market valuations. You put a chart up there that some people might not be that familiar with, which was the S&P market cap to US GDP. Now, if we put that in terms of a PE ratio of the S&P 500, where are we now relative to long-term history, and where might it start to look attractive?
Right. The PE ratio we tend to favour is called the Shiller PE. This is the cyclically adjusted PE, so it tries to take where you are in the cycle out of it. But that is still very stretched.
Okay.
That is still 20% above its long-term average, and so that has further to come. It's way down from its peak, which is good, because let's face it, markets have fallen 25% here, and that's good. Things are cheaper. We just think they need to get a little bit cheaper yet before we're going to move into equities.
And obviously, when we talk about PE, there's two ways for that to come down. Either the price comes down, the stock price, share price in the equity markets comes down, or the earnings improve. Now, I don't think it's likely that the earnings of a lot of companies are going to be improving from here. In fact, are we seeing any signs of companies pulling down estimates of future earnings?
There were a few signs yet, and this is a little bit puzzling. But why analysts are not sort of bringing their earnings estimates down? We think it's because they're not getting the guidance to do so from the companies concerned. But some companies, the real bellwethers of the U.S. economy, like FedEx, for example, have come out with forward guidance, which is quite bad, and their share prices have fallen sharply. So I think this is the next shoe to drop. You will see earnings estimates coming through. That E will decline, which actually raises the PE, which puts even more pressure on the P to come down. But what you need here is you need to have process which forces you to go and do the right thing. And as equities come down to those levels, there'll be a bit of fear around, but you have to go in and buy them, and that's what we do.
Well, Tony, thank you very much for your comments, and thank you for joining us in Cape Town for a short while.
Great to be here, Rob. Thanks.
Obviously, that was Tony Cousins, CEO of Pyrford International and Portfolio Manager of the Ned Group Investments Global Cautious Fund. Thank you.